Economic players. Z firms, private entrepreneurs or firms play a key role in capitalist economies. They hire wage labor, use capital and land, and produce goods and services for profit. Z government. The state enforces laws, provides public infrastructure, runs schools, and delivers public services. It may also undertake production and taxation. Z household sector. Households consist of individuals or groups that make consumption decisions, save, and pay taxes. They earn income through work, wages, salaries, or profits. Some basic concepts of macroeconomics. Final goods. Z final goods are products meant for ultimate consumption and do not undergo further transformation in the economic process. Example, food, tea leaves, clothing, etc. Z final goods can be divided into consumption goods, goods consumed directly, and capital goods, durable goods used in production. Intermediate goods. Z intermediate goods are products used by producers as inputs in the production of other commodities. Z they are not considered final goods and do not enter the consumption stream directly. Z examples are steel sheets used for making automobiles and copper used for making utensils. The role of money. Z money is used as a common measuring rod to quantify the total value of final goods and services produced in an economy. Z money allows for the aggregation of the monetary value of different goods and services, providing a quantitative measure of final output. Stocks and flows. Z stocks are assets or goods existing at a specific point in time, while flows represent quantities over a period. Z capital goods, such as machinery, are stocks, while changes in capital goods over time are flows. Gross investment. Z gross investment encompasses capital goods and infrastructure like machinery, buildings, roads, and bridges within an economy's final output, indicating its commitment to future development. Depreciation and net investment. Z depreciation is an annual allowance for the wear and tear of capital goods over their useful life. Z net investment measures the new additions to the capital stock, accounting for depreciation. Consumption versus investment. Z economies face a trade-off between producing consumer goods and capital goods. Z increased production of capital goods can lead to higher future production capacity and, ultimately, more consumer goods. Interconnectedness of production and consumption. Z the production process generates factor payments, which create purchasing power for consumers. Z capital goods play a role in this cycle by facilitating production and generating incomes. Circular flow of income in the economy. Z the description of the economy provides a simplified model without government intervention, external trade, or savings. Z in this model, households receive income from firms for their productive activities, and there are 4 types of contributions: labor, wage, capital, interest, entrepreneurship, profit, and natural resources rent. 2 basics of macroeconomics. 6 basics of macroeconomics. Z households spend their entire income on goods and services produced by domestic firms, and there are no taxes or imports. Circular flow of income in a simple economy. Methods of calculating national income. Measurement of aggregate income. Z aggregate income can be measured through 3 methods: expenditure method, product method, and income method. Z the expenditure method calculates aggregate income by measuring the spending firms receive for final goods and services produced. Z the product method measures aggregate income by calculating the aggregate value of final goods and services produced by all firms. Z the income method calculates aggregate income by summing up all factor payments, wages, interest, profit, rent. GDP by 3 methods. The product or value-added method. Z the product method is used to calculate the aggregate annual value of goods and services produced in an economy. It involves summing up the value added by all the firms in the economy. Z example. The example involves 2 types of producers: wheat producers, farmers, and bread makers, bakers. In a year, farmers produce wheat with a total value of 100 rupees, out of which they sell 50 rupees worth of wheat to bakers. The bakers use this wheat to produce bread with a value of 200 rupees. Value added. The term that is used to denote the net contribution made by a firm is called its value added. Value added by a firm is calculated as the value of production minus the value of intermediate goods used. For the farmers, their value added is 100 rupees, the entire value of their wheat production. For the bakers, their value added is 200 rupees bread production, minus 50 rupees, the value of wheat they bought from the farmers, which equals 150 rupees. Farmer baker. Total production 100 200. Intermediate goods used 0.50. Value added 100 200 minus 50 is equal to 150. Production, immediate goods, and value added. Gross value added and net value added. If we include depreciation and value added, then the measure of value added that we obtain is called gross value added. If we deduct the value of depreciation from gross value added, we obtain net value added. Unlike gross value added, net value added does not include wear and tear that capital has undergone. For example, let us say a firm produces 100 rupees worth of goods per year. 20 rupees is the value of intermediate goods used by it during the year, and 10 rupees is the value of capital consumption. The gross value added of the basics of macroeconomics 7. Firm will be 100 rupees to 20 rupees equals 80 rupees per year. The net value added will be 100 rupees to 20 rupees. 10 rupees equals 70 rupees per year. Inventory. Inventory in economics refers to the stock of unsold finished or raw goods a firm holds from one year to the next, with changes indicating accumulation, increase, or decumulation, decrease in value over time. It's a crucial variable for assessing a company's production and sales dynamics. The change of inventories of a firm during a year is identical to production of the firm during the year, sale of the firm during the year. For example, let us suppose that a firm had an unsold stock worth 100 rupees at the beginning of a year. During the year, it had produced 1,000 rupees worth of goods and managed to sell 800 rupees worth of goods. Therefore, Rs 200 is the difference between production and sales. This 200 rupees worth of goods is the change in inventories. This will add to the 100 rupees worth of inventories the firm started with. Hence, the inventories at the end of the year is 100 rupees plus 200 rupees equals 300 rupees. Notice that change in inventories takes place over a period of time. Therefore, it is a flow variable. Inventories are treated as capital, and addition to the stock of capital of a firm is known as investment. Therefore, a change in the inventory of a firm is treated as an investment. Three major categories of investment are as follows. Inventory investment. This involves the increase in the value of a firm's inventories over a year, considered as an investment expenditure made by the firm. Fixed business investment. It comprises investments in machinery, factory buildings, and equipment by firms to enhance their production capabilities. Residential investment. This category relates to investments made in housing facilities, such as construction and improvement of residential properties. Change in inventories can be planned or unplanned. Unplanned accumulation of inventories occurs when sales fall unexpectedly, resulting in unsold goods beyond expectations. Conversely, unplanned accumulation of inventories happens when there's an unexpected increase in sales, reducing inventories more than anticipated. Note, if we sum the gross value added of all the firms of the economy in a year, we get a measure of the value of the aggregate amount of goods and services produced by the economy in a year, just as in the wheat bread. Example. Such an estimate is called gross domestic product (GDP). Thus, GDP is identical to is the total gross value added of all the firms in the economy. Expenditure method. An alternative approach to calculating GDP is through the expenditure method, which focuses on the demand side of products. For example, the 50 rupees worth of wheat that the bakers buy from the farmers counts as intermediate goods. Hence, it does not fall under the category of final expenditure. Therefore, the aggregate value of output of the economy is 200 rupees, final expenditure received by the baker, plus 50 rupees, final expenditure received by the farmer, equals 250 rupees per year. In the example of the farmer-baker economy described earlier, The aggregate value of the output in the economy using the expenditure method is determined as follows. Z. Calculate the final expenditures made by each firm. Final expenditure refers to spending, not for intermediate purposes. Z. Sum up the revenues earned by each firm from final consumption, C. Investment, I. Government spending, G. And exports, X. Z. For the entire economy, calculate the aggregate final consumption expenditure, C, which includes spending on domestic firms but excludes spending on imported consumption goods, CM. Z. Calculate the aggregate final investment expenditure, I, which includes spending on domestic firms but excludes spending on foreign investment goods, IM. Z. Determine the aggregate final government expenditure, G, for the economy, which includes spending on domestic firms but excludes spending on imports, GM. Z. Calculate the aggregate exports, X, received by the economy from foreign buyers. Z. Subtract the aggregate imports expenditure, M, which includes spending on imports of consumption goods, CM, imports of investment goods, IM, and government spending on imports, GM. Z. Express GDP using the expenditure method as GDP equals C plus I plus G plus XM. This equation provides a way to calculate GDP based on final expenditures on consumption, investment, government spending, exports, and imports. It is worth noting that investment expenditure, I, is often the most variable component in this calculation. Income method. The income method of calculating GDP focuses on the incomes received by all the factors of production, such as labor, capital, entrepreneurship, and land. It establishes a relationship between the sum of final expenditures and 8 basics of macroeconomics. The economy and the incomes earned by households in factors of production. Here's how the income method is applied. Z. Consider there are M households in the economy, and let Y represent the wages and salaries received by the IDH household, Pi for gross profits, INI for interest payments, and RE for rents in a specific year. Z. GDP is calculated as the sum of these various income components. GDP equals sigma, Y, plus sigma, Pi, plus sigma, INI, plus sigma, RE. The symbol sigma is a notation. It is used to denote summation. Z. The total income earned by all households is expressed as GDP. Z. This method essentially states that the revenues earned by all firms in the economy should be distributed among the factors of production such as salaries, wages, profits, interest earnings, and rents. When considering the income method along with the value-added method and expenditure method, they all provide different expressions of the same GDP variable. These methods represent the relationship between production, expenditure, and income. Market prices represent the final prices of goods and services that consumers pay. To calculate market prices, one needs to add product taxes, like excise tax, service tax, export and import duties, and subtract product subsidies from basic prices. Factor cost, basic prices, and market prices. Z. The Central Statistics Office (CISO) of the Government of India has been reporting the GDP at factor cost and at market prices. In its revision in January 2015, the CISO replaced GDP at factor cost with the GVA at basic prices, and the GDP at market prices, which is now called only GDP, is now the most highlighted. Measure. Z. The measurement of national income in India involves various concepts such as GDP at factor cost, GDP at market prices, GVA at basic prices, and the distinction between production taxes and product taxes, as well as subsidies. GDP at factor cost. This is a measure that focuses on the value of total output produced in the economy, considering only the payment to factors of production, like wages, rent, interest, and profits, and excluding any taxes. In India, GDP at factor cost was widely used as a measure of national income. GVA at basic prices. GVA, gross value added at basic prices, is a concept that considers the value of total output produced in the economy minus the value of intermediate consumption, goods used in further production, not for final consumption. It includes net production taxes minus production subsidies. The relationships among these concepts are as follows. GVA at factor cost plus net production taxes equals GVA at basic prices. GVA at basic prices plus net product taxes equals GDP at market prices. In recent years, the Central Statistics Office (CISO) of the Government of India has shifted its focus from GDP at factor cost to GVA at basic prices as a key measure of national income. This change highlights the importance of understanding the distinction between various taxes and subsidies related to production and products in calculating national income.